Hello, good morning to all. Welcome to a brand new week ahead. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. I'll be presenting your daily dose of market insights by OANDA. So very good morning for a brand new week ahead. Today will be Monday, the 22nd of January, 2024. All right, so before we start our daily dose of market insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product. So, as well as any forecast, prediction, or projection in this document, in this presentation, pardon me, is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So before we start our short-term technical outlook for today on the various cross-asset classes, let's have a recap on what happened last Friday and as well as the key events and the performance of the cross-asset classes. So Friday, we do have a very strong performance in the US stock market, especially on the tech-driven sector or tech-driven indices, the Nasdaq 100, the SPX 500. So the Nasdaq 100 actually lead the market with positive 1.95%. The SPX positive 1.23%, and both of them ended the week with 1.17% and plus 2.86%. So the Dow Jones Industrial Average and the Russell 2000 lagged behind, but still ended the session with positive 1.05%, and the Russell 2000 positive 1.08%. So if you look at the weekly performance or the weekly candlestick of these various benchmark US stock indices, I'll share with you on my screen here, especially the Nasdaq 100. So the Nasdaq 100 over here ended the week with a very strong bullish candle. So we could see over here a strong bullish candle, very similar to the S&P 500. Okay, so it's ended with a very strong bullish candle as well, positive 1.117% for the week of last week. The Dow Jones Industrial Average, not that bad, positive 0.72%, but not as strong as the Nasdaq 100 and the S&P 500. The Russell 2000, even though ended the week on a negative tone, so this is the weekly candle, so negative 0.34%, but however, it actually ended right with a bullish weekly hammer right at the 50-day moving average, so pretty much positive as well. So what we could see over here is that the driving forces of this pardon me, let me share with you something. Yeah, so the driving forces, right, of this movement on last week S&P 500 and the Nasdaq 100 and the rest of the major US stock indices, at the start of the week they actually started on a negative footing, but right at the towards the end of last week, I mean on Thursday, Friday, it has been led by the technology sector. So this is the 5-day rolling performance of the 11 key S&P sectors, because they've been broken by 11. So technology and communication, for sure, they're actually leading the pack, plus 4.19%, plus 1.6%. So you could see over here, then this is the S&P 500. Very clearly, a bit of AI optimism is back into the market. So a lot of market participants, market actually look, a lot of us are pretty much concerned whether can this rally continue on the upside. So later I'll share with you some other technical indicator when I go into the short-term technical outlook. Okay, so there is the cross-asset performance on the major US stock indices, showing various signs of what I call bullish optimism, especially being led by the AI and technology focused sectors. Then the next key thing to ask ourselves over here is the FX market is pretty much dollar. We do have a bit of dollar weakness coming back into the market and go kind of sideways, WTI sideways as well. But what's interesting over here is that the optimism on the US stock market is actually ignoring this continuing of a push up in that 10-year US Treasury yield. So if you look at the 10-year Treasury yield, is holding still pretty much firm above 4.06%. That was the former resistance that's been taken out and still trading above the 200-day moving average. So with an uptick in the US 10-year Treasury yield, traditionally in the past, it tend to lead off to a bit of risk-off scenario in the US stock market. But the US stock market is ignoring this right now as it continues to trade on its own, driven by what I call the AI optimism is back into the and AI and the technology optimism is back into the US market. All right. So one key economic data to look out for that I want to highlight last Friday was actually this United States Mohegan consumer sentiment data. So this is the preliminary data, flash data for the month of December, January. Pardon me, January is out on last Friday. So it actually surpassed expectation. Markets expecting 70, but actually rose to 78.8. So an uptick in 78.8 over here. That was actually the highest level since July 2021. So that actually also give a bit of boost in terms of we call it consumer sentiment, rosy outlook that is back into the market as well. So that actually has a kind of a positive impact on the stock market. But with an uptick in consumer sentiment, that actually kind of suck out a bit of what I call the need for the Fed to actually cut rates as soon as what market is expecting in March this year. So if you look at the CME Fed Watch tool right now, so for the one that is in March, okay, so initially market is expecting about close to what 70%, okay, cut in March about a week ago, 76.9%. But on Friday, this number has dropped down much lower from 50 previously on somewhere around share in Wednesday, mid or last week. So on Friday, it dropped down to 48.1%. Okay, so less than 50% right now. So all in all, right, it seems that market has really started to tone down the first interest rate cut to actually initially market is priced about 70% odds to come in March. So right now the optimism has started to tone down to 48% chance as being indicated by the CME Fed Watch 2, taking into account of the data from the 30-day Fed Funds futures market. But market doesn't seem to be quite of a concern right now, given the fact that the AI optimism is back into the picture. All right. So now, with that, right, that is pretty much sum out. I want to cover about last Friday key movement and key data, and in relation to the we call it the Fed Funds futures, CME futures pricing on the on the expectation on the Fed Fund rate cut in March. So with that, right, last kickstart on the short-term technical outlook. Yeah. So let's start with the major US stock indices first. All right. So with that, right, let me share with you a particular chart, not really on the technical chart, but on the market breadth. All right. So on market breadth, we could actually plot market breadth on trading view as well over here. Okay, so this is the market breadth. I'll share with you all. So sometimes when I start to see conflicting signals, intermarket conflicting signal, that means what do I mean? Yes, sectors going to show upside momentum, but however, intermarket analysis like the US 10-year Treasury yield is on the upside. Technically speaking, it should actually lead to a risk-off scenario on the US benchmark stock indices, but it's not showing on last Friday. So what I'm trying to say over here is that can this momentum continue? So I will look at the market breadth instead. So what's market breadth, right? It's like 52-week high minus 52-week low. So what I could see over here, right? This is the market breadth. Okay, so what I do over here is the SPX 52-week high minus 52-week low on the daily chart. But usually if it's on a daily basis, right, it will tends to be very if it fluctuate very erratic. So what it means that if I were to share with you this one, this is a very erratic chart on a daily basis. So what I do over here, I smooth it over by using a 50-day moving average. All right, so let me hide this again now. So, okay, hide it. So this is a 50-day moving average on the new 52-week high minus 52-week low. So what you could see over here is that the net result, right, is a bullish breakout on the S&P 500. It's very similar on the Nasdaq as well. The new 52-week high minus 52-week low, there's also a bullish breakout as well. So this is, I will smooth it on the 50-day moving average. And also I look at a much more shorter term percentage of S&P 500 stocks above the 20-day moving average. All right. So what we could see over here is that it starts to slope upwards as well, higher low. Very similar percentage of Nasdaq 100 stocks above the 20-day moving average has started to slope upwards as well. That means it starts to actually improve after coming down in the last 4 weeks. Okay, at 67%, at 45%. Okay, so all in all, what you could see over here is that there's a number one, there's a bullish breakout on new 52-week high over 52-week low, both on the S&P and the Nasdaq 100. Percentage of stocks that are going above their 20-day moving average in the S&P 500. That means all the S&P 500 component stocks. There is actually an improving breadth of number of stocks going above the 20-day moving average, and this breadth is not overstretched on the upside. That means it hasn't reached around 80-90% odds. So it's just showing signs of improvement. The S&P 500 slightly now at 45%, the Nasdaq 100 at 67%. So what it means that improving breadth, not breadth that is so positive that hit the extreme overbought level at around the 80-90% plus mark. So what I could see over here is that breadth is actually still supporting further potential bullish buyers, at least in the short term, on the major US stock indices. This is what I'm trying to portray by showing you these guys. These are the what I call breadth indicator that we can look at, and we could plot it using TradingView chart. All right, so that's the beauty of TradingView, by looking at various form of technical elements to give us a gauge on the momentum of the S&P 500, the major US stock indices, both on a longer term basis as well as the short term basis. So with that, let us jump straight to the key technical levels I will share with you for today on the Nasdaq 100. Okay, so we are now very clear. So let's share the Nasdaq 100 over here. Okay, where is the Nasdaq 100? Yeah, good here. Okay, so let's start with the Nasdaq 100 first. So Nasdaq 100, right, what we could see over here is that market moves within our expectation and hit the resistance that we highlighted earlier at 17,290. And right now it's coming very close to the next resistance, which is the FIBO extension level at 17,470/7,500. Okay, so if we draw the next, it's a cluster of FIBO, taking into account of the much more shorter time frame from 17th of July, January, projected from the high of 19th of January, last Friday, swing high and swing low. Okay, that give us 1.61% and very close to this level as well. And the 2 times will be at 17,580, 17,660. So with that, right, RSI for sure is at a very extreme overbought level on the hourly chart. Okay, so this level is the most overbought extreme since mid of December last year. But yes, even though it's at an over extreme level, it hasn't hit a bearish divergence scenario yet. Okay, price movement on the hourly RSI still shipping higher high, not lower high. All right, so let me expand my screen so that you guys could see much clearer. Okay, good. So what we could see over here, right, since hitting the next resistance at 17,500, there could be a chance of a potential pullback today, coming into the European session and heading to the US session thereafter. So pullback level, right, potentially could pull back to last Friday's resistance level that highlighted 17,290 level. But I do not want to put 17,290 as a too tight as a short-term pivotal support level. So what I could see over here, right, the pullback could take shape between 17,290 and 17,130. So what's 17,130, right? If I do the entire FIBO retracement of this steep up move, okay, it's close to 38.2%. All right, so that could be a wave two, okay, minor wave two retracement. So with that, I would use 17,130 in any chance if that pullback would take shape and the pullback don't surpass below 17,130 level. That means there could be a pullback between 17,290, 17,130, but as long as it didn't surpass below 17,130, I was still maintaining this short-term bullish bias on the Nasdaq 100. Looking forward towards a next potential uplift towards the next resistance at 17,580/17,160 level. Only an hourly close below 17,160 potentially would negate this ongoing impulsive short-term bullish tone to kickstart a much more deeper minor corrective pullback to retest the next support level at 16,910 level. 16,910, which is also confluencing very closely to this towards this upward sloping 20-day moving average as well. Then 16,910 is the former minor range resistance of 11 on Jan to 15 on Jan, now turns into a pullback support level. All right, so Nasdaq 100 still maintaining that short-term impulsive bullish outlook, but notwithstanding the fact that now the hourly RSI is at extreme overbought level, there could be a pullback first, 17,290, maximum 17,130 before shaping that next impulsive up leg towards 17,580 / 17,660 on the Nasdaq 100. Dow Jones Industrial Average, US Wall Street 30, broke above our upper neutrality limit at 37,550 last Friday. Also surpassed the previous all-time high level at 37,800 level. So with that, the hourly RSI also at an extreme overbought level. Okay, not that extreme as the Nasdaq 100. It hasn't surpassed the mid-December level yet. All right, so the mid-December level was this level here. Okay, it hasn't hit that level yet. Okay, so not as extreme as the Nasdaq 100, but most importantly over here is that it's at overbought level, but it didn't show a bearish divergence as price on the RSI going to shape higher high in line with the price action on the index. So with that, right, it's coming very close to the next resistance at 38,100 level. So very similar to the one that I shared on the Nasdaq 100 as well. So the Nasdaq resistance recap again is at the 17,500. All right, so put that in parallel with the 38,100 level on the US Wall Street 30. So what it means that over here, upon hitting this level over here, there could be a chance that it could start to actually shape a pullback level, all right. So this pullback, I don't put it so tight, around 37,800 as my short-term pivotal support level. So I put it slightly lower, 37,550. So if you do 37,550, if you do the Fibo retracement of this impulsive push up, is at 50% Fibo retracement level. So it also confluence with this upward sloping 20-day moving average as well. So using 37,550, any chance of a potential pullback, it shouldn't surpass this level. As long as this level is maintained, 37,550 for today, we will still maintain that short-term bullish outlook on the US Wall Street 30. Thereafter, the next resistance to watch after 38,100 will be at 38,400 level. However, if we start to see an hourly close below 37,550, that means last week push up is a failure bullish breakup. So we may start to see another round of choppy corrective decline move to retest the minor range support level again at 37,170, which is in place since 15th of December low. Okay, so net flipping to a bullish bias in any pullback, holding above the short-term pivotal support level at 37,550 on the Dow Jones Industrial Average, which is the Wall Street 30. Now, moving on to be the European currency. The German 30 came within our expectation. Bullish bias remains intact, hit the resistance level and surpass it at 16,440, and also during the Asia session, it managed to clear above the 20-day moving average as well. RSI hit the overbought level, but not at the extreme overbought level yet so far. And what we could see over here is that the extreme overbought level so far since middle of December last year is around at this mark of 85. Okay, he hasn't hit 85 level yet, and also there's no signs of a bearish divergence as well, as RSI continue to shape higher high in line with the price action. So with that, yes, there could be a bit of pullback coming place. So pullback level to watch will be at 16,640. Last Friday resistance now turns to pullback support. As usual, I do not want to put it so tight at the 16,640 level, so I'll be using 16,515 short-term pivotal support for today, a tightened one. So if you look at the Fibo retracement of this last impulsive push-up, it also came close to the 50% Fibo retracement as well. So in any chance over here is that as long as 16,515 level holds in any potential pullback, I will still maintain that short-term bullish outlook, with the next resistance to look out for will be at 16,790, followed by the all-important level at 16,970. So this is the range resistance that managed to keep previous bulls in check since the high of 14th of December. All right, so net still maintain that short-term bullish outlook on the German 30, any potential pullback. This pullback potentially should hold at 16,515 level, this level over here, before we start to see a new potential push up. First resistance towards 16,790, followed by 16,970. Only an hourly close below 16,515 will invalidate this or negate this short-term bullish outlook to see another round of choppy decline to retest 16,330 on the German 30 index. All right. Strong push up on the Japan 225 today. Okay, Japan 225 push up, hit the support level, hit the resistance level that we highlighted since last week, 36,460 slash 36,660. So what we could see over here, right, this a push up in the resistance. The hourly RSI also managed to do a bit of pullback, now exiting from the overbought region level. But the way it exit from the overbought region level, prior to that, there's no bearish divergence. RSI going to shape higher high in line with the price action. So what I could see over here is just a normalization of its exit from the pullback from the overbought level. So indicated to us that there could be a chance of a pullback right now taking shape towards the former minor range resistance that was previously formed on 15th of Jan and 17th of January, broke out on last Friday, now turns the pullback support at 36,150. So I would want to use it so tight at 36,150 as my short-term pivotal support for today. I'll put it slightly lower at 35,820, which is the swing low of last Friday Asia session, and also confluence with the lower limit of this minor ascending channel that is in place since 4th of Jan 2024 low. And if you do the Fibo retracement, it as of the last impulsive up move is close to 61.8% Fibo retracement. So using that 35,820, so as long as 35,820 holds for today, chance of a pullback towards this zone over here before shaping another potential push up towards the next resistance at 36,660, break out above it, exposes the next psychological level at 37,100 level. So still maintaining that short-term bullish outlook on the Japan 225 with a adjusted short-term pivotal support level in any chance of any pullback at 35,820. Only an hourly close below 35,820 will invalidate this short-term bullish outlook to see a start of another minor corrective decline to test the swing low area of 18th of January, that means last Thursday swing low area at 35,350. Okay, the one that is always underperforming will be the Hong Kong 33, like I shared with you all, due to what I call structural problem. So right now it's actually testing the 15,000 level again. All right, so this 15,000 level over here is pretty key in the short term. So with that, as long as there's no hourly close below this level, there could be a chance of another bounce towards last week congestion area on the upside at 15,525. However, the hourly close below 15,100 level, potentially we will start to see the start of another impulsive downleg to test 14,600. So 14,600 is in fact the October 2022 low over here. Okay, so what I could see over here is that this previous rally up that was in October all the way up to 27th of January 2023 last year. So this was the what I call COVID reopening story in China. All this has been we call it a wipe up due to the fact that in China itself, it's not actually enjoying the fruits of a weaker dollar like we see in the rest of the world. Even though like Japan and other, we call it emerging market stock index, the fact that because in China, like I mentioned earlier, is due to structural problem, risk of a deflationary spiral with the ongoing persistent weakness in the China property market, and not beholding the fact that the China top policymakers are still refusing to add further liquidity into the Chinese economy. All right, so they are actually not using the stock market as a tool anymore to boost the economy. All right, so that's the fact that we got to actually look at it right now. Yeah, even though valuation are cheap in China, okay, but it's not creating a positive animal feedback look back into the stock market. So that's why that's explain the weakness, the persistent weakness that's being seen on the Hong Kong 33 right now. Okay, so that's pretty much sum up with the short-term technical outlook. So I would like to share with this, the outlook is a short-term technical outlook. So short-term ranging from 1 to 3 days. So this 1 to 3 days of short-term technical outlook on the major stock indices still continue to maintain that bullish bias that I shared with you on the respective short-term pivotal support level, but however with a low conviction on the Hong Kong 33 index. Okay, now moving on will be the FX market. So on Friday on the FX market, right, we flipped to a bearish bias on the dollar because of the emerging of the new technical, some elements I shared with you all. So if you look at the dollar index over here, right, not say dollar index, pardon me, the okay, I want to share with you all, there is this, where is it gone to? Okay, yeah, here is it. Okay, here you go. So this will be the 5-day rolling performance of the US dollar against other major currency as of today. So I could see over here is that on last Friday, right, the dollar strength starts to dissipated over here. So I could see that we start to see a bit of dollar weakness coming back into the picture on the 5-day rolling performance basis. So the dollar is the weakest against the sterling and against the CAD. Dollar yen starts to actually temper out as well, the dollar strength ahead of BOJ meeting tomorrow. So later I'll touch on about BOJ meeting tomorrow towards the end. So if you look at the 1 month rolling performance basis, right, it could actually start to see it temper off as well. Okay, on the 1 month rolling basis with the dollar the weakest against the sterling pound. So we see a bit of dollar weakness coming back into the picture. So with that, right, we will be still maintaining our this short-term dollar weakness bias against the euro. So you look at the euro over here, right, it starts to inch much higher on last Friday, but can't break above the 50-day moving average, which is the first resistance that we mentioned at 1.0905. So with that, right, I'll be still using 1.0840 as my short-term pivotal support level, which is also the 200-day moving average that managed to survive on last Thursday. So with that, right, still maintaining that bullish bias on the euro dollar. Only a clearance above 1.0905 potentially sees the next resistance coming in at 1.0965, which is also confluence with the 20-day moving average as well. Only an hourly close below 1.0840 will negate or invalidate this short-term bullish outlook on the euro dollar to kickstart another leg of a minor corrective decline to test the next support level at 1.080. Sterling dollar. So sterling dollar will be a bit more hesitant because it's now coming to the top of this range level, which is this minor descending trend line resistance. So it could be still trading within a triangle configuration that I depict on my mouse over here. Okay, with the triangle support at 126 figure. This is an hourly chart of the sterling dollar. So I'll still maintain a neutral bias, sideways bias on the sterling dollar, top of the range at 1.2760, followed by the bottom of the neutrality range at 1.2640. So it's more a sideways range between these two levels. Okay, in the short-term outlook basis. So still maintaining that short-term neutrality stance or neutrality bias on the sterling dollar between 127.60 and 126.40 level. Now moving on to the Asia Pac currency, Aussie dollar. So what you could see over here is that the Aussie dollar actually going to move upwards, enjoying the kind of ongoing risk-on behavior as a whole that is being depicted on the global stock market with except on the China and the Hong Kong stock indices. So very clearly, right, it surpassed the 200-day moving average and hit also the first resistance at 65.95 that we highlighted on last Friday. So now this becomes a pullback support, a minor pullback support right now. Okay, so with that, right, I will have a Titan key short-term pivotal support for today at 65.70 on the Aussie dollar. So taking into account that this also is the 50% Fibo retracement of the last push up as well. So with that, right, as long as 65.70 short-term pivotal support holds on the Australia dollar, potentially, right, I will still maintain that short-term bullish outlook on the Aussie dollar with the next resistance coming in at 66.50. So what 66.50 is the former congestion area over here from 5th of Jan to 11th of January, and also this ongoing minor descending trendline resistance that I draw from the high of 28th of December last year, confluencing at 66.50 as well. Only an hourly close below 65.70 will negate this short-term bullish outlook to see another choppy slide down to retest last Thursday's swing low area at 65.20. All right. dollar yen. So dollar yen last week we have a bullish bias going towards the next resistance level to watch will be at the 149 figure, 149.30 level. But what's interesting over here is that yes, it shaped higher high, almost hit the the resistance level that we highlighted in our bullish bias on last Friday. So we did mention that that was a residual push up. So that residual push up hit a high of 48.80. So upon hitting a high of 48.80, right, the price action shape higher high, but however the RSI start to shape lower high instead at the overbought level. So this is what I call a bearish divergence condition, indicating to us that this push up from 12th of Jan all the way to last Friday intraday high, which is just a whisker below our resistance at 149 figure, 149.30, is losing upside momentum. So with that, right, it seems to us that the dollar yen has started to get impacted by the dollar weakness that is being seen on Thursday or last Thursday onwards across the other major currency pair that I shared about earlier. So with that, since that residual push up is more or less been met, I'll be using 149.30 as my short-term pivotal resistance for today, looking for a potential short-term bearish bias. First resistance to watch 147.30, a breakdown below it 146.25, which is also confluence with the 50-day moving average acting as a resistance level as well, as a support level as well, pardon me. Only an hourly, so flipping to a short-term bearish bias on the dollar yen, 149.30 key pivotal resistance support level. First, we support key pivotal resistance level, flip to a bearish bias on the dollar yen. First support level to watch 147.30, followed by 146.25. Only an hourly close above 149.30 will put a damper on this short-term bearish bias to see a squeeze up to test the next resistance at 15020 slash 15070, which is the top of this minor ascending channel, and a 1.236 Fibo extension level. Okay, now, major going on will be the gold, spot gold. So let's look at spot gold over here. So spot gold XAU slash USD also managed to surpass back above the 50-day moving average, but hasn't go above the 20-day moving average, which is this congestion area over here, 2045, 2060. So with that, right, I will use a Titan key short-term pivotal support for today at 2015, which is close to the 50-day moving average, and as well as this 61.8 Fibo retracement of this last push up from last Friday and Thursday. All right, so as long as 2015 short-term pivotal support holds for today, potentially XAU slash USD gold could actually see another test at the 20-day moving average in short term, acting as a resistance at 2045. Above it exposes this minor range resistance that is in place since 5th of January at 2060 level. Only an hourly close below 2015 will negate this short-term bullish outlook on XAU slash USD gold to see another slide to retest the psychological level at 2000. Okay, lastly will be WTI crude oil. So WTI crude oil over here, let me share with you where's WTI crude oil. Yeah, West Texas oil. So West Texas oil going to churn within this minor sideways range configuration that is in place since late December last year. So last Friday, it managed to test the top of the range limit again at 75.95 slash 76.05 before coming back down. So managed to now shape a bounce off the first support level at 72.60 level. So I don't know when you used to use so tight, right? Because it's churning, is still doing this wild whipsaw right around the 20-day moving average. So this is the 20-day moving average. I think it's a support level, which is also the minor swing low on last Thursday. So I'll be still using 71 figure level as my short-term pivotal support level, still maintaining that short-term bullish outlook within this complex sideways range configuration that is in place since late December last year. The resistance to watch out for will be at 74.95 slash 76.05. Only an hourly close below 75 level, 71 figure level on the short-term pivotal support will negate this short-term bullish outlook with a range configuration to see another slide to retest 69.70, which was a 3rd Jan swing low area. Okay, so that's pretty much sum up for the short-term technical outlook today across the various cross asset classes. So now key economic data to look out for today, right, will be if you look at today's session, will be rather quiet on Monday. So yes, just a while ago, with expectation, right, the loan prime rate was unchanged from China. Okay, the 5-year, 1 year and 5-year loan prime rate. So this indicating to us that the China top policymaker is rather reluctant to add further fiscal stimulus measure into the China market. Okay, so that's for Monday over here. Okay, so let me share with you all the data again. Okay, whoops, sorry. Calendar. Okay, so this week calendar. Okay, so for tomorrow key data, right, will be at 11 a.m. the Bank of Japan interest rate outlook. So for Bank of Japan interest rate outlook, let me briefly touch on it right now because today is a bit extended because I share with you much more details. Is that BOJ for today, right? For tomorrow is very likely to maintain interest rate at negative 0.1%. It will not change. Why? Because they are still pending for the ongoing wage negotiation between Japanese employees, their unions that represent employees, and the corporation. So the wage negotiation will only end around March this year. So very likely, Bank of Japan will wait for the outcome of this negotiation before what you call it, attempting to actually shift negative interest rate to at least to zero somewhere around March to April. In April, the April BOJ meeting. So during this meeting, very likely market participants will see whether Yuda, the bank governor, will start to give any hints that he is in favor of shifting negative interest rate pretty soon. Okay, so market participants will hear his statement, his press conference and the statement being issued out at 11 a.m. Right, and also they also released the quarterly outlook report as well. So market participants will also like to see whether there will be a revision to inflation rate for this year and next year. All right, especially. So net all in all, right, I want to highlight to you all some things that overall what we could see at this point in time over here is that a lot of people will start to say that dollar yen is still a driver of the Nikkei 225. That means in order to see Nikkei 225 going higher, dollar yen got to be increasing on the upside as well. So yes, that was in the past. This is dollar yen chart. That means if dollar yen going up, that means yen weakness is required to support a bullish Nikkei 225. But however, since October and August last year, the 20-week correlation between the dollar yen and the Nikkei 225 has started to reduce from a positive high number of 0.8, 0.9 all the way down to negative 0.28 right now. So what it means that over here, right, the main driver, the current driver of a bullish Nikkei 225 doesn't necessarily indicate that the yen got to be weak, but rather the strength of the Nikkei 225 is much more now dependent on external economic factor like the US trend of the S&P 500, where we start to see the 20-week correlation of the S&P 500 and Nikkei 225 continue to remain in a very high positive level at positive 0.84 right now. Okay, so net, this one to stress over here is that even though Japan BOJ starts to actually adjust its short-term negative interest rate policy, which is potentially actually is good for the Japanese economy, telling the Japanese corporation and the Japanese consumer that, hey, guys, right now we already starts to exit up from a decade plus of deflationary area. So please starts to be more confident in spending more in Japan. Okay, so this is the signal that BOJ tried to actually convey to the Japanese corporation and consumer, which means that even though dollar yen may start to get weaker based on this normalization policy of BOJ that is going to take soon, but that will not translate potentially to a weaker Nikkei 225 right now, because right now the current dynamics of the Nikkei 225 is much more dependent on other external factor rather than a weak yen. All right, so with that, today's session will be a bit long because I need to share with you all the current dynamics that is taking shape right now in the marketplace. And hopefully I could actually explain a clear picture with you, the correlation between the dollar yen and the Nikkei 225 at this current juncture. So with that, have a great day ahead and we shall speak again tomorrow. Thank you.